when we are trying to determine how much to pay for a single family house, what do? How do we know if we're getting a fair price? Appraisal. And what does the appraiser do? Finds comparables, right. So the appraiser will go out and he will look at other houses in an area and find ones that are comparable. And if he can't find ones that are comparable, he'll make adjustments to ones that are almost comparable. So if something's is brand new and this house you're looking at is 10 years old, he or she will make adjustments, And so they're looking at comparables. When you're trying to determine how much to pay for a multifamily housing, for rental housing, comparables don't work. So as a result, instead, they use something that's called the capitalization rate. And the capitalization rate converts a series of cash flows, like rent payment coming in, net operating income, it converts that into a value. One of the unknowns about cap rate is what rate of return the market expects in a certain neighborhood. And we're relying on the appraisers or the people doing the market study to tell us what rate of returns people are expecting in that neighborhood. What we know is that the riskier the neighborhood, the more disinvestment there's been, so the worse shape the neighborhood's in, the higher perception of crime there is, the worse the schools are, the higher the cap rate. Meaning if someone's going to invest in that neighborhood, they're going to expect a higher rate of return than they invest in a neighborhood that is in great shape, credit's flowing, people are buying houses, people are renting their units, and the schools are great and there's no crime. So the neighborhoods we're working in, we expect to be working in, we're probably going to see some relatively high cap rates, which affects the value. Now, why, if the appraiser is going to do this for you, why do we want to cover this in here? Why shouldn't we just let the appraiser do it and not deal with it? This is a quick way for you to look at a property and be able to determine, you know what, they're asking way too much for this property. There's just no way this is worth this amount, and it can be used as a negotiating tool. So after lunch, we're going to look at an offer sheet for an existing rental development. You're going to see the kind of information you'll get. And by looking at the kind of information you'll get, you'll be able to see how you'll be able to use the capitalization rate to know whether the price is somewhat in the ballpark or whether they are way off. Okay? So, in our example, our market rate example, we were borrowing 80% of the amount of the cost of the unit, and we were doing it at 6.5%. So the way we would start to calculate what our capitalization rate is we divide that 6.5%, multiply rather the 6.5% times the 0.80. Now, I am saying that our internal rate of return as investors, we're all investors now for a minute, so pretend you're an investor. We're all investors now. We want 8% return. We can get 3% from the bank. We can get 3% from the bank for say, and it's 100% safe. We're looking at a neighborhood that's a little dicey, and it's not a 100% sure thing, so we want 8%. That's our internal, that's the rate of return we're saying we want. That's not unusual in this market. Okay? So we're going to multiply our 20% times the 8% return we want. We get 1.6. We add those two together, we've got now a 6.8% cap rate. To calculate the value, we take the cash flow. In our market example y'all have, the cash flow is $111,000. We're dividing that by the cap rate. That's why the higher the cap rate, the lower the value of the property. Because we're dividing the cap rate by the cash flow. We're dividing the cap rate by the waterfall. We calculated what the waterfall is. We're dividing that by 6.8. So the value of that property was $1.64 million. Okay? So we, in our example, we were going to end up spending $1.3 million. So we were getting a good deal. Because based on that cap rate and based on the cash flow, it really was worth $1.6 million. So $111,706 was what our cash flow was. If the cap rate was 9%, then our value went to $1.24 million. So if the cap rate's the higher the cap rate you use, the lower the value of the property is. Does that make sense? It doesn't intuitively make sense. Trust me on this one. Okay. The higher rate of return we want on that property, the less we're willing to pay. We've got $111,000 cash we're going to get out of this. Okay? Remember, we're not NSP people because we're not getting cash out of it. We're NSP people. We're just trying to figure out, when we quickly look at the net operating income of these deals, we want to be able to look at this. We want to have the ability to be able to walk in, look at this, and say, "You want $4 million for that? It's only cash flowing at $111,000. No way, bank. You've got too much. You overinvested this property. That's not my fault. This is what I'll pay." Right? Because we're going to be mean-spirited investor negotiators, right? Right. Okay. Right. All right. So what this enables us to do, and what we've done this before with some of our pre-development loan program deals, is one guy in particular in this part of the state fell in love with the deal, fell in love with this apartment complex. I've got to buy this apartment complex. Perfect. And when my colleagues, Hannah Escrow, was working with him, she couldn't talk him out of it. So finally, she went, there was all these reasons you shouldn't do it. And so finally, she just was able to get the cash flow, get the offer sheet, let's look at what the net operating income is. She said, okay, here's this very modest cap rate, divide it. They're asking for twice as much as it's worth. And it was a project-based rental assistance deal. And they were basically trying to value it as if it was market rate. Because the cash flow, because it was a project-based rental assistance, was much lower than if it had been market rate. And they were just trying to find an unsophisticated buyer who would be willing to buy it. And they found it. Fortunately, he found us, and so he didn't buy it. But this is a way, knowing this is just a way to say, okay, I got an offer sheet that we'll look at after lunch. I can take this offer sheet, I know what the net operating income is, I'll divide it by a cap rate, boom, I know whether or not we're in the ballpark. So once we identify what it's worth, okay, to us based on this cash flow, then when we have our capital needs assessment that we just paid for that's going to tell us exactly how much it's going to cost for us to repair it, we now know what we can afford to pay. Okay, it's worth 1.6, but I've got to put $700,000 in it and make it to where it's habitable. So I'm not willing to pay 1.6. I'm only willing to pay $900,000 because I had to come in with $700,000, and at the end of the day, with the cash flow, I've only got a piece of property that's worth $1.6 million. So understanding this valuation is going to be a way to help you negotiate your end price on when you're buying these existing rental buildings. We do this for real and lay out for you all the expenses, and he's also going to look at comparable rent rates. The one we're going to hand out in a minute, it was a project-based rental assistance deal, and the fair market rent, they were $200 per month rent below the fair market rent. Okay? And they were a little bit, I can't remember, when we walk through it I'll remember, but they were a little bit below what all the comparables were rent-wise. So they could have gotten a rent increase probably approved through HUD. Then you kind of want to take that into effect, and hopefully you know that and the seller doesn't, because if it's a bank and somebody in Dallas, Gladys pointed out someone in Dallas, they may not know, it's an REO manager, they're just dealing with lots of properties trying to move them. They may not know that you would negotiate low by saying, hey, the income's going to be this, I'm only paying 1.6, but I can instantly go to HUD after I close and get a $100 increase in the rent. See, and that's one of the things, in the public sector, we're not used to doing that. That's sneaky, right? That's taking advantage of someone. Someone's got this piece of property that's worth this amount, and you know it's really worth more. In the public sector, our mode has always been, let's be fair. We're going to do what's right. We're not in that mode now. We're investors now. And so our mode is, if we know that we got a low deal on the piece of property, we know they could get a $100 a month increase from HUD just by filling out a form because they're well below FMR. We're not telling the bank that. We're keeping that to ourselves. And then we're going to negotiate that price. And then once we get our price and we buy it, then we're going to go and tell the appraiser, you kind of blew it because the cash flow really this, up it so I can get a bigger discount, right? I don't know if that'll work, but if they're appraised at low, you bought it low, and you got your discount, it might be worth it to you at the end to go back to the appraiser and say, I think you made a mistake. Look, here's what my cash flow really is because I got this increase from HUD. It was really worth more when you appraised it. And that way, that's the appraisal we want to use when we're trying to show HUD that we really did our 15% discount on our portfolio.